On today's show, we're talking Supreme Court tariff reversal, optimizing your HSA, and retirement plans for fun. Let's go.
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Monday's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Sean.
And I'm Rabih.
Yeah, you are. Welcome, guys. Sean, it's good to have you.
Thank you.
It's been a while since we've had you back on, so
yeah, it's great to be back.
This is fun. And then, of course, Cash GPT is here, as always.
Computing, as always.
I got to tell you something really quick. I was talking to a dentist earlier this week, and this is kind of like one of those compliments we were kind of like, thank you, I think. He was talking about the shows that, the content we do in the podcast. He's like, man, I love your guys' stuff. He's like, I don't listen to your main show on Wednesdays, but I do listen to 2 Cents every week. I was like, thank you. I think he was saying like your main stuff sucks, but like 2 Cents is cool.
You know what we should do? We should like have a couple of 2 Cents episodes where they're just rerun of the first show.
You can see what people
prank people.
See if they catch it too.
See if they catch it. Like, wait a second. No, as always, good to be here, and we truly do. We love hearing when the people listen to the show and that they not for us and our ego, maybe for Rabih's a little, but mainly for just the fact that it's working. Like, our goal is to add value to the dental space, and we love hearing the feedback and the fact that people are enjoying it. So that's awesome. And speaking of that, so I would dare say, you guys tell me, but I feel like it's a pretty easy litmus test of like how cool you are as a dentist if you listen to our stuff, right?
Oh, yeah.
I feel like there's even a greater test of that. It's whether or not you're coming to the Dentist Money Summit. Like, I think from what I've gathered, I think it's kind of, the data shows that the coolest dentists are coming to the Dentist Money Summit June 11th through the 13th. Did you hear that, Sean?
I did, actually. Yeah, I was talking to some clients from Boston, and they said, we want to come to the summit, and they're really cool. So I think there's correlation there for sure.
Yeah, this is actually, according to the ADA and the Health Policy Institute, massive research done that the coolest and like best dentists are coming to the summit. It's not me, guys. I'm not saying that, but
the studies.
If you want to be a part of this elite group of dentists, you should go to dentistmoneysummit.com. Check it out. Now on to the good stuff. Rabih, I was at the gym this morning.
Hold on. Can we just comment on that marketing, because it is really funny.
Was that good?
Yeah.
I don't plan this out most of the time.
Yeah.
The whole thing of like vibe coding. This is a new thing with AI. Like, people like vibe code.
Yep.
I think I vibe podcast. I'm just like, yeah, this
sounds good. Let's roll with it.
Let's just go. Feels good. Okay,
it.
Rabih, I was at the gym this morning, and it's unavoidable at the gym. 50 screens in front of you, all CNN or Fox or whatever. And the number one thing across all the screens was Supreme Court tariff reversal voted down. Trump's tariff voted down 6-3.
Yep.
Let's talk about it.
Do the gyms do this on purpose to raise our blood pressure?
Maybe. Could be increasing the caloric burn. Yeah.
Maybe. But yes, and it is, honestly, for the last couple of weeks, when the president was tweeting about it and said if it was reversed, we'll be in big trouble, I thought this would be, like a big signal, like the market will have a big reaction. And now, after the fact, when you look at all major indices, this is turning into a noise, which surprised me as someone who's following the markets every single day. But let's just give some background to the listeners or what's happening. If you were panicking last April on Liberation Day when the president unilaterally decided to start imposing tariffs on all countries on this planet, whether it was minimum or whether depending on a certain formula, we moved to a new fiscal regime where the US said, hey, if we're in a trade deficit with you, we want to start making some more money because you're buying from us more than we sell you. And the whole idea behind that economic move or policy move was to allow some US dollars to flow back into the country in the form of tariffs. And hopefully that will reduce the federal debt that exists or the deficits that are showing up. Fast forward till today, It didn't break the consumer as much as it would, although prices have gotten a little bit expensive. We've collected around $175 billion of money from this tariff move.
Small amount, yeah.
It's a small amount compared to the macroeconomic repercussions and, political repercussions. And all of that was at the same time, we were having a legal battle at the Supreme Court whether the president has the right to impose tariffs on other countries. The president legally has been saying, well, this is an economic emergency. Under an economic emergency, I can do whatever I want. The Supreme Court says, well, you can do whatever you want, but what you did, which is tariff, which regulates trade, is not an emergency. It's more of a regulatory thing. So it's not in your power. Tariffs are a form of taxes. They are taxes on international trade rather than domestic consumption. And like all taxes in the world, all taxes in the US, the law says that they should be assigned by Congress. Congress has to vote on raising taxes or lowering taxes. So you guys, I think you can see like the precedence it would set. Like if the president can set a tariff, which is considered legally a tax on international trade, what will stop a president from increasing taxes on your day-to-day purchases, whether it's value-added tax or income tax? So they don't want to set that precedent because a big part of the U.S. tax law is, hey, no one raises my taxes. All of Congress has to do it, type of thing.
Which is why it's hard to change tax policy in America.
100%. So we're going to get that. What is very interesting so far is that there's debates, but nothing official has been released on whether those $175 billion will be repaid. And how will they be repaid? And in which mechanism? Which is going to be, a big rabbit hole logistically, just because I don't know if the Treasury Department even has the means for such.
Can we just call it good? Just feel like
what a steal.
Brush it under the rag.
Our bad. We're going to move on.
What is interesting is not what is happening between like the Supreme Court and the president. Those are the balances of power. The U.S. goes through these every couple of months. What is interesting is how markets reacted and what this means to you as an investor or someone who's allocating and rebalancing their portfolio as a function of such. Given now it's more noise than signal, it gives us a hint that, just move on. Focus on the next big event. But let's talk about how markets reacted. The most important one, which is bonds, right? The 10-year interest rate is kind of flat today. Did not react at all to the news. What we would have expected the 10-year interest rate to do was, okay, if those tariffs were actually bringing money into the economy and now removing them is going to put us in a very tough situation where we are now re-questioning our ability to pay down our debt because suddenly we were using that tariff money to pay down the debt, but now we can't pay the debt. Well, stopping it would mean that the US debt isn't really as attractive as it used to be. You would expect interest rates to go up. People would want to stay away from US bonds. That did not happen. On the flip side, right, if we were thinking in terms of the narrative that those tariffs really ruined our interaction with the rest of the world. Other countries will not want to do trade with us. Also, all macroeconomic studies and experts tell us that if you want markets to work, you do not impose restrictions within it, taxes included. So removing these tariffs is going to be very healthy for the global economy because we're now running on a more efficient terms and we're going to be making more money. You would expect the 10-year interest rates to go down. So neither of these narratives actually pushed forward, which is very interesting. But on another end, there is more data that came up earlier this week and today that are probably more important than the Supreme Court decision. We got what core PCE is at. It's still at 3%. We got the Q4 GDP growth. Obviously we get 3 readings for it, but the first reading came that GDP in Q4 grew at an annualized term of 1.4%. Models were saying we're going at 3 annualized. The Fed saying, we're going to have a very bad quarter. It didn't. It came at 1.4, which means all of 2025, the GDP grew at 2.25%. In 2024, we grew at 2.8. 2025, we're growing at 2.2. So there's a slowdown in the economy. We notice it, we understand it, but we're still above the 2% level. We're still above our target growth level. And expectations were we would be growing higher. The Fed expected 2025 to grow by only 1.7%. So we're much better than Fed estimates, but lower than last year. So this is more important than one batch of tariffs and whether we're going to pay it back is going to move the needle. How the economy is growing and the trajectory we're going with is much more important, which is reflected in bonds. So the other thing is how equities reacted, and equities were up, surprisingly. Equities were down when tariffs were announced, went back up when they were reversed, right? And when delays started happening. And now when the Supreme Court said, okay, we're going to draw the line and we won't allow this to continue, stocks actually bumped up, which is a very interesting observation, but I wouldn't look a lot into it. Probably stocks are in favor of policies that promote global integration
trade,
and global trade, because if you guys all remember, 50% of the revenue that the S&P 500 companies make come from outside the world. So it kind of tells us that the stock market wants the whole world the stock market only cares about the economics of things. They're not looking at the politics of things. It's as simple as that. So given all that, putting the analysis aside, and if you want to sit and start like thinking, what would we do? What would we change to our clients? You would think of your portfolio, and your portfolio is still allocated with around like 70% to the US if you follow major indices, around like 25% to developed ex-US markets, and around 12 to 13% in emerging markets, right? This is the current state of the balance between these economic regions. And does this give us a clear indication that we need to shift one way or another? All of them are doing well. This is what the market thinks their allocation should be. Trade is not changing the macroeconomic regime. You just keep your exposure diversified in either direction. So if something happens, you have a portion in your portfolio that's doing well.
I remember a time, Rabih, when tariffs were going to totally collapse the entire global economy. That was the message. We've now, it feels like, kind of fast forward to now, it's like you said, it's just noise.
It is noise. A hypothesis in my mind is that now we can work around tariffs much faster. Think 50 years ago, if you're a global company like, I don't know, Exxon or GE back in the days, and suddenly tariffs were imposed, how hard was it for you 50 years ago to change your supply chains, to be able to route your raw material from one way to another?
So difficult.
So difficult. So a tariff had a very long impact before you were able as a company to find that efficiency again. Whereas now it's so easy. Global business is so integrated that you can come up with solutions. You can go to different lenders. You don't have to do a lot of market search because everything is at the palm of your hand. You can really pivot as a business really quickly and bypass any from a business perspective, a tariff is simply just a more expensive way for me to do business. I'm just going to do what I always do and find a better way to do it.
Work around it.
So that is probably the reason.
So my question would be, and then I want to get Sean in here if he has thoughts. So is it fair to say all these agreements through this process that Trump in the administration was going through with all the different countries, right? That was kind of like his way to leverage all these different agreements. What happens? Is everything just kind of like go back to square one?
No, I don't think so. It's interesting. And probably that's why like markets are happening. It's like we won't have the tariff going forward, but we were able to win some deals on the table because the deal that is placed with other countries, remember last year we were reading them like, oh, you get from me that much plastic and I get from you that much oil. They were entertaining for the part being. But what was interesting is that most of these trade deals were designed on the basis of quotas. Like I buy from you from this industry, you buy from me from that industry. With like China, the deal was that you commit to a certain amount of tons of soybean and we commit to a certain amount of chips, etc. So it's not really I commit to giving you that tariff rate and you commit to giving me that tariff rate. It's more about the quantity of trade being exchanged. the fact that tariffs will now have to come probably from a Congress vote or something else does not really impact that deal. But who knows what clauses are in there. But I don't think so.
Got it. That makes sense. I don't know, Sean, if you have any thoughts or...
Yeah, more just a question on who do we think are, I guess, the losers from the reversal besides Trump, of course. How does that affect industries? Specific industries?
If at all, yeah, it's a good question.
Actually, if you want to look at it just from as how efficient the mechanics of running government has been, well, this is inefficient. We've spent a year deploying taxpayer money and resources, doing research, doing study, rattling up the international community to then have to backtrack everything. A more efficient way would be that, hey, if I'm introducing a policy, my hope is that all the investments that I've done to get this policy throwing doesn't have to be thrown away. I think the biggest losers are the American people, because Trump still has the power and he'll figure out a different way to do it. But we are sitting here looking at our taxpayer money being used for inefficient governance, rather than, we set a plan, we execute it, we move on to the next thing, we get a return on our taxes paid. This is not what's happening.
Yeah, I think government and efficiency are not things that go together usually. Okay, anything else to add on that, Rabih?
No, I'm fairly confident that in the next couple of weeks we'll have more news to talk that are completely different than this. And
I'm sure we will. Awesome. Okay, well, let's move on to Sean. How do we optimize the HSA?
Yes.
What is an HSA?
Yeah,
Sean?
HSA, health savings account. So just briefly, there's a lot of nuances and details as is the case with most investments and with, of course, the tax code. But in summary, health savings account, or an HSA, is an account that you can have on most high deductible health insurance plans. So you have to have a specific plan with a high deductible that is HSA eligible. And what it allows you to do is to separately put aside some money into this HSA. And as you do that, there's a couple of advantages that you get. So it's one of the accounts that's called a triple tax advantage. So as you put money in, you're getting a tax deduction on what you're contributing to your HSA. So that's on the federal level. And then 48 of the 50 states allow you to also get a state tax deduction. Sorry, California, New Jersey.
Of course.
Yeah,
of course,
right?
It's California.
Of course, always. So that's one benefit to it. Number two is if you decide not to use the money, maybe you don't have health expenses or you want to pay for health expenses out of pocket, you can invest those funds and they grow tax-free. And then if you withdraw them at any point in time to pay for qualified medical expenses, then all of both what you deposited as well as your earnings can be withdrawn tax-free. So it's really that triple tax benefit of you get the tax deduction, your growth is tax-free, and as long as you're using the funds for qualified medical expenses, you're also not paying taxes on just all that growth and all that amount after all is said and done. So that's kind of a quick summary of what the HSA is. I am an HSA truther. I've loved it. It's been great. I'm very much on the bandwagon for
HSAs
HSA.
For you are like credit cards for Taylor.
Yes, exactly.
He's a credit card point truther.
Yes,
You're an HSA truther.
Yes,
I like it.
I am. Sometimes I get grief about it. We can't forget the HSA. So I just feel like it's very powerful because it allows you to kind of have this super account. And for me, where it's really helpful is, yes, you can use it as you have health expenses come up, which is great because you're getting the tax deduction on money that you're contributing. So it's saving you on taxes. But what I really like in the way to optimize it is to, if you're able, to be able to pay for medical expenses just out of pocket. So just, from your bank account, or your credit card, whatever it may be. And then to invest the funds in your HSA, let them grow, and then don't touch them, so that one of two things. Number one, when you're retired, ideally you have this big chunk of money that you can use for medical expenses in retirement. Because if you use them for medical expenses, remember, you're not paying any taxes on all of that growth over time. Or number two is what I do right now. I have 4 kids. Kids are expensive. All my kids have some sort of health
Don't tell Rabih
situation,
that. We're on a
an
mission.
issue.
We're on a mission. Don't tell them they're expensive.
I know.
Kids are amazing, Rabih.
Kids are the best. They don't
Yeah.
cost anything. And you get a tax deduction for tax credit for having kids. But because of that, what I'm doing is I'm saving receipts. I'm not saving like $5, $10, $15 receipts, but I'm saving receipts for big procedures and different things, because there is not a limit on how long I can go with submitting a reimbursement from my HSA. So in 30 years, I can go back and say, hey, I'm going to get a reimbursement for this $10,000 I spent for my daughter's health stuff that happened in 2025. And so it's really a great
Rabih's face.
opportunity. Yeah. Really a great
I'm
opportunity
gonna go look
down
into
the
my
road.
grandpa's drawer and see
Yeah.
all his medical bills.
Yeah.
So there's really a lot of benefits to being able to have an HSA and fund it. And just a question, I guess, that I will throw out that I've often thought about is, I strive to fund this and to max it out every year. There is a limit, so you can't just put as much as you want in here. There's an individual limit, which is $4,400 for 2026. There's also a family limit, which is $8,750. Don't ask me why it's not exactly the double the individual
Don't even get
limit,
me started.
but is what it is. And so, yes, there is a limit of how much you can contribute each year. But we can see over time, if you've got 15, 20, 25, 30 years until you're going to be needing this money, and you're putting in, between $4,400 to $8,750 every year. This is growing as, it's adjusted for inflation every year. It could be very easy to have hundreds of thousands of dollars in your HSA in retirement. So the question that's in my mind is there ever a point that you want to stop funding your HSA and utilize, hey, instead of funding that, let's put it in the brokerage account instead. You don't want to overfund your HSA. What are your, I guess, initial thoughts as you think about that?
Yeah, it's a good question. For me, it's maybe. The answer to that is maybe, depending on the overall situation. The worst answer ever is it depends always.
Yeah.
But I'd say for most dentists at the high, like at least the dentists that we work with, the dentists we talk to, most of them are in a place that they're not going to be like HSA poor, if you will. Like there's a higher likelihood of being, let's say, 401k poor because the limits are so much higher. HSA to me is like it's very similar to an IRA. And I like that you use the word optimization. Like it falls under the category of an optimization tactic.
Yeah.
It's not a core like this is the first thing you should do. Like where I would say a scenario might be, Sean, that I've seen where I'd say you wouldn't contribute to the HSA necessarily in a certain year is something like a glaring lack of liquidity.
Yes.
That might be an issue. That would take precedent over an HSA. But I'm with you generally as far as being a truther. I think an HSA for most dentists being high cash flow, high income professionals that are always looking for ways to reduce taxes, HSA is probably the best possible account that you could use. You could use for that strategy. So I love it. But I don't know if Rabih has thoughts on this too.
I actually have two questions for you. The first one is does this for the cases where it makes sense to open an HSA, does it take precedence on when you fund it compared to other one? Like if someone is, it's in their best interest to fund and open an HSA, would you say put the money there first, then put the rest in your 401k or IRA? Like what takes precedent in that situation?
Yeah.
And the other question is, am I correct to think that the biggest risk for people who want to use an HSA is their medical expenses? So probably younger people would want to do it, but older people would want to stick to a high deductible and let insurance take care of that risk?
Yes.
What do you guys think?
Yes. So first question is where I've usually seen it makes most sense is if you have a 401k and you get an employer match, that's kind of your first priority. You want to get those free dollars. I know that's not the case for a lot of our clients, a lot of our dentists being the business owners. But after that, I think the HSA makes a lot of sense. Jumping into your second question, Rabih, if a high deductible health insurance plan makes sense in your situation, it doesn't for everybody. In my family situation, it has. I compare the costs every year and the benefits and figure it out and do kind of a nerdy analysis. in my situation, it has made sense, but it definitely doesn't make sense in every situation. So there are some who, because of that, they're not going to be on a high deductible plan that is eligible for an HSA. So it's not this applies to everybody, but do see that an HSA being on a high deductible plan for a lot of people can make sense.
Yeah, I'll just say on the sequencing of it, or like kind of the waterfall of like where would it go first. I think rational minds could disagree of like, HSA versus a back to Roth conversion, or, do I put money in a brokerage account versus like, I think again, we're talking about like optimization for your specific situation. But again, the idea is, and I'm admitting we maybe have some selection bias from like who we work with. The ideal scenario for a youngish mid-career practice owner is that's never going to need to be like a big decision, like meaning that you've got enough cash flow that the sequencing doesn't matter too much. Like you're going to have excess to put into a brokerage account after you've done your 401k, after you've done your backdoor conversions and your HSA. I like what you said, Sean, the example you gave of saying that an associate, that's a different story of an associate. I agree. Getting the match is always going to be top priority. And then from there, it depends on the associate situation. Like, are you a career associate, or are you trying to buy a practice or start up a practice the next couple of years? That is going to be a much different sequencing of cash flow versus someone who's like, no, I'm going to be an associate for the rest of my life. And so a lot of it's going to just be case by case, but ideally you wouldn't have to worry about kind of that order of things at some point in your career. The other thing I was going to say really quick, because one of the pushbacks I get on this strategy, even internally from our team, shout out Jake, we love you, is this. I think it can fit into the category. I really do think there is an argument here of like, okay, are we just over optimizing things now? But one of the specific pushbacks we get on this is around the like tracking of expenses over the next 20 or 30 years. I get that. I get that people are like, is the juice really worth the squeeze on this? But here's what I'm going to say to that. Maybe you don't want to do that. The HSA withdrawal like categories are so broad that it doesn't matter. Like you probably don't even need to track big expenses in reality because of two things. Number one, the categories are broad. Number two, if you just look at probability, chances of needing this money for health related expenses when you're 50, 60, 70, you're probably not going to need to reimburse yourself. You just can pull it out. I mean, there's things like massages, nutritionists, you can pull supplements, you can pull the money out without having to worry too much about tracking every little thing. So I want to dispel that like worry that people have. I'm all in on this strategy for the right situation. I think using it just like you would an IRA. And then last thing would be you actually can flip this to an IRA. So by the time, I think at 65, Sean,
65, yep.
At 65 years old, if let's say you've got $1 million sitting in your HSA and you're like, I'm probably not going to use all this, you can flip it to an IRA, like literally make it an IRA. So, and then pull the money out for whatever you want. It changes the tax benefits of it, but still.
Yeah, you can use it just like an IRA at 65, where yes, any money you pull out that's not for medical expenses is treated like an IRA. So you would be taxed on the growth or what you're pulling out at that point.
Yeah. So Rabih, like when you take me to like Turkey when we're retired and we travel the world together, and you have an HSA,
not gonna
like you could take me with you.
Show him the plane tickets, and I tell him pack your bag.
You could use this at, I guess when I'm 65 or when you're 65, I'll be dead. Either way, this is great, Sean. I love it. Any other thoughts or things you want to add to this?
Yeah, just quickly, a couple things to consider is, I know this will obviously change in the coming years, but Fidelity did a study a few years ago. They said the average 65-year-old today is expected to spend between $165,000 to $175,000 on healthcare in retirement. So there's going to be expenses. There's going to be healthcare. You can also use the HSA to pay for certain Medicare premiums. Long-term care is something that a lot of seniors end up needing. That can be expensive. So it's almost another way of self-insuring for long-term care as well. It's kind of how I've looked at it.
The other question here, and we don't need to go into too much detail here, but just planning considerations for this too. Rabih, you brought up sequencing of cash flow in. Also need to consider sequencing of cash flow out, because inheritance of certain accounts is different, and the HSA is not the most friendly inheritance tool. So that would lead to, in retirement, how you'd sequence a withdrawal strategy as well, just a planning consideration. You probably wanted to be depleting that fund
Yes.
before anything else.
Yes, exactly. Because if it's a spouse who inherits it, then it's great. It's just like they had it, no tax consequences or anything there. If it's a non-spouse or it's your estate, then the whole amount actually becomes taxable after your death. So definitely something to consider, and an
Yep.
account that you want to make sure you're using in retirement, specifically for any health expenses that you have.
Yeah, I love these conversations because it spans the whole, like the totality of the planning discussion and
Yeah.
career of a dentist. Of like, there's so many things to consider here. Cool, that was great, Sean. Thanks for breaking that down. Kind of within this same vein, I had a conversation earlier this week with a dentist that I think fits the mold for a lot of dentists out there. Pretty complicated situation, multiple businesses, entities, all dental adjacent. They've got multiple practices, and then they've got dental adjacent companies that they're kind of building all simultaneously. But because of that, they've got simultaneous or different LLCs, different entities. And so we have been planning out their retirement planning strategy, like what retirement plan for which entity, and can we do multiple and all this stuff, back to Roth conversions, like all this stuff. But specifically for them, and again, I think this fits for a lot of dentists, because they've got different entities, a couple in particular that they've got no employees on because of the structure of their business. The question specifically was, okay, we set up a solo 401k for one of his entities and they're maxing it out. They did it for 2025. We're going to do it again for this year. And then it came up in our meeting and he said, well, I've had a SEP IRA on this other entity. Can I utilize that as well? Can I max that out at the same time? And so that was kind of the planning scenario. Can you have both plans? And I've heard this multiple times from dentists. I think this is pertinent. So here's how this works. So here's what I wrote him. I actually ended up making him a video after making sure I understood all the details and nuance and did the research. And I went back to and made a video. And here's what I said. My initial answer: can I max or can I use both at the same time in the same year? Solo 401k or 401k and a SEP? The answer is sort of. That's the answer. Thanks everyone for listening. Have a great. No, I'm just kidding. So the answer is sort of. So technically you can. However, there is what's called, under ERISA regulations, so ERISA is kind of the governing document of regulations that controls, that sets the rules for retirement plans. And there's in that document is rule 14 or 415C. We're getting fun. This is a fun weekend topic, guys. Simply put, what it states is every single person has a overall maximum contribution limit that you can put into a retirement plan, like a 401k, a SEP, a simple. That includes employee contributions, employer contributions, and profit sharing. So for 2026, the 415C limit is $72,000 per person. So what that means is, again, sort of, if this particular person, this dentist, is not fully utilizing or maxing out the solo 401k and doesn't reach that full limit across those three categories of employee, employer, and profit sharing, and let's say there's $10,000 left because of the income he's generating from that LLC, then yes, he could go ahead and utilize that SEP IRA as well. But the overall overarching limit of $72,000 stands. So in this particular case, the SEP IRA becomes irrelevant to him because he's making plenty of money in his core LLC that he's going to max it out, him and his wife. I thought, hopefully that's helpful. I want to kick it to you guys because I think this is something that comes up a lot with dentists who have different practices or entities or side businesses. Any thoughts or questions you guys have?
So the summary is sort of, because if your LLC does not make enough money where you can contribute 72K, you can have the rest funded into the SEP.
Correct.
Got it.
Yep.
Okay.
So it's not saying, like, technically you can utilize both a SEP and a 401k in the same year. You really can. We're not going to go down this road, but there's control group affiliated business rules, brother sister business rules. There's rules you got to follow as far as like how related are those businesses, what's your ownership structure. Like in this particular case, we literally had to bring in an ERISA attorney for other reasons to figure out control group issues. So that's a whole other issue. But assuming you don't fall under control group or affiliated business categories, and you just have two separate businesses, one with a SEP, one with a 401k, you technically can fund both. You just can't go above 72 grand for this year. So,
Yeah.
Sean, any thoughts or questions
Yeah,
on that?
I mean, it can be really easy to miss this or to be confused about it because it is pretty complex, especially where you're thinking and considering my contributions as an employee and also as a business owner. What are the employer contributions? What does all that look like? It's really easy to lose track. So, if you have questions, please find somebody that can answer your questions because you don't want to get in trouble with this.
Yeah, it's true. And I think a lot of dentists think to that point of contribution limits, they think, oh, contribution limit. Yeah, this year it's $24,000. That's the employee contribution. You add the match and you add profit sharing, you actually can get up to $72,000. That also is that's kind of the story here actually, is if you and your spouse are on a solo 401k, you can't have employees, but you can both each have it and you make enough money. We're talking, 6-figure plus of contributions to reduce your tax liability. It's significant. So again, you just got to make sure, to your point, Sean, that you're tracking all these different kind of buckets and not maxing out two different plans, because that would be a big no-no.
Yep. And if you're over 50, there's an additional amount too for the catch up. So something to consider too.
Yeah, it can get significant. Yeah. Exactly. Okay, Rabih, that was a good weekend chat. What do you think? What are you thinking?
I either want to stay in touch with you or stay in touch with your lawyer about the RISA documents because literally that is a lot of moving parts, to be honest.
It's a lot.
But I'm glad you guys know how it's done so we can provide value and I don't have to worry about it.
It's amazing how many times we see, I mean, again, dentists are hard charging type A, let's go build this thing type of people, the ones that we work with. And they're so common. We see dentists with multiple businesses. I just talked to a dentist this week who has a tech software in dental adjacent, building a pretty significant tech software business in dental and runs a full-time practice. And there's so many implications there around, okay, I want to start building a retirement plan. It's like, we've got to make sure we're not commingling control. It's a lot. It gets complicated. So attorneys definitely need to get involved in a lot of these cases. Okay, well, guys, I think the most exciting part of everyone's weekend is coming to an end. We're so sorry. We're kind of we're entering kind of the worst part. The Olympics are ending for sports. Have you been watching the Olympics, Rabih?
A little bit, especially, the skiing parts and the crashes.
Yeah, of course. Of course. It's been fun. But we appreciate everyone listening. Sean or Rabih, anything else you want to add? Any other words of wisdom for the people?
No, all I can think of, if we're not in April yet and we're going into that many details about plans, just wait until tax season comes up.
Seriously.
And this podcast is going to turn into...
We should be bringing on our tax team on 2 cents to break down some things. We should consider that. So, if you're out there listening, first of all, if you're still listening, you're one of the cool ones. We appreciate you listening. We hope this adds value. If you're sitting here thinking, man, that was a lot. I've got these questions. I need help with this stuff, whatever it may be. We are here to help. disadvisors.com. We'd be happy to talk to you, hear your story, answer your questions. Click on the yellow book free consultation button, and we'd be happy to talk to you. For now, Sean, Rabih, thanks for being here, sharing your words of wisdom. Everyone, thanks for listening. That was our 2 cents. Have a good weekend. Bye-bye.